Good morning. This is Larry Edelson from my Uncommon Wisdom Weekly Video Market Update for Thursday, March 3rd. Certainly, we're seeing lots of action in a lot of the markets, a lot of volatility. We're seeing the ongoing Middle East crisis escalate. We're seeing situations around the world that are causing considerable tension and volatility in all the markets, and especially in gold and silver. So, having said that, let's go right to the charts for this week. I want to point out some important things to you. First, the gold chart. Now, let me address a couple of things here. There's no question that in the short term I have been wrong on gold and silver. Initially, I had forecast back in December a move down to the 1225 level. We did get a move down to 1307 in gold. That's this move right here that you can see on the chart down to here. But then, quite violently, gold turned around and moved up sharply, and just on Tuesday pierced to a new, very slight new record high. Now, again, I repeat, there's no question on the short term that I have been wrong. On an intermediate term and long term basis, you know I am as bullish as before, if not more bullish than ever before. But let's take a look here on the short term. Is this really a move that you want to get on board and trade this short-term move? I say no. I am not doing it, and for a variety of reasons. Number one, the cycles, as I've written in some of my recent columns and editorial, point to another sharp low in mid-March, possibly into the latter part of March, for both gold and silver. And I don't believe that cycle is inverting right now. I do believe that we will see gold and silver roll over to the downside quite sharply as we head into the mid and latter part of this month, as strong as they look on the short term. There are several reasons why. One of the reasons is that if you look at this volume on the lower part of this chart here, you'll see that the volume, while spiking higher, is not confirming this rally. Gold has been moving up, but volume, despite a couple of spikes, has been overall in a declining mode. There are several other indicators I use that tell me the internal strength of this gold rally is not what it should be. And there's also several other reasons why I have elected not to participate in this short-term rally. For one, I don't believe it's on a solid foundation, despite all the fundamentals being clearly in gold's favor. And number two, from a risk-reward point of view, I believe there's too much risk into jumping aboard this rally at this point in time. Keep in mind, gold is going a lot higher. My minimum target is around 2,200, 2,300. That is a bare bones minimum. In all likelihood, over the next 2 to 3 years, we will see gold reach 5,000 and possibly as high as 7,700. So I'm not interested in these short-term $40 or $50 moves. I'm interested in buying at the right price for the longer-term move up to at least 2,200, and again, I repeat, more likely 5,000 or even $7,700 gold. Interestingly enough, I did hedge up the portfolio, so if you're a long-term investor following my recommendations in the Real Wealth Report and even in Uncommon Wisdom, you are largely hedged, or you certainly have not aggressively bought into this rally. Your gold shares are responding okay, although with one caveat, they too have not confirmed this gold rally. But my point being, even if you're hedged up, you're not getting killed by any means in this rally. I did take a couple of speculative short positions in silver, which did turn out to be a loser. A put option in gold as part of a hedge for my Resource Windfall Trader subscribers, which did turn out to be a loser, but it was a small insurance premium to be paid to protect the portfolio. I remain of the position that while gold can move up, let's say to 1445 in here, until it closes above, solidly above $1,453, I am not going to be adding to any positions in the gold market. And even then, if we do get a close above 1,453 in gold, then I will be looking for a pullback to buy and not a breakout. Let's now take a look at the silver market here. Let me get that chart up for you. Silver is certainly going parabolic. However, for a variety of reasons I've cited in my editorial and in previous videos, I do not want to jump on this silver market, the silver bandwagon. I prefer to wait for a pullback. Silver has a knack, and we can see this over the last 30 years, for spiking higher and then collapsing, giving back 50% of its gains, even as much as 65 or 80% of its gains in a matter of days. So it is quite possible that silver, as strong as it looks, at $34, $35, could top out and fall very swiftly in a matter of days, all the way back to 22, perhaps even lower. Right now, silver is coming into a critical area of resistance that you can see that I've drawn this rectangle here. There are several trend lines and cyclical lines converging right in here at 34.5, 35. If silver does move above it and breaks through this resistance level, that would indeed be a positive sign, but like gold, I would still be waiting for a pullback to get on board silver. Now, importantly, I have refrained from silver for quite a while now, and that is because I needed to see its action confirm that it had the potential to go into long-term bull market move. This move, this last $10 move up in silver, has confirmed that, but I do not want to buy silver here. I want to buy it when it pulls back to the $22 to $23 level, and ditto for silver shares. And as tough as that may be to wait patiently through this, I believe it will be well rewarded, because the risk is simply too high right now, and I would rather be buying silver on a sharp pullback and silver shares on a sharp pullback. Because now that silver's bull market is confirmed, once a decent, good test of support and a correction and a cyclical pullback is in place, and the prior breakouts in the $22 to $23 level are confirmed by a pullback that successfully holds those areas, then we will see silver go up quite nicely over the next couple of years to $75, even $100 per ounce, and that's the move I want to catch. I do not want to get on board this parabolic move right here. I've been in that situation before. I have seen silver go up quite rapidly, only to give back in literally a day 50% or more, even as much as 80% of its gains. It's happened in 1980, happened in mid-1985, in 80s level. It happened in late 1987, it happened in 2 occasions in the 1990s. It is going to happen again, and a lot of people are going to be left holding the bag, unfortunately. Mostly Johnny-come-lately retail investors that are jumping in at these high prices in silver without seeing a solid pullback. Now, having said that, let's take a look at the dollar, which I find also very interesting right now. This is the dollar index. I've been warning you consistently that the dollar is in a long-term bear market, and even the short-term action in the dollar index has proven me correct. The dollar, despite all the arguments and fundamental reasons why it should be putting in a better performance, especially the Middle East crisis. Middle East crisis and other crises around the globe tend to send investors into the dollar as a safe haven. It's not happening right now. Most of that money is going into gold and silver and not the dollar. The dollar remains very weak. It has now tested the bottom trend, the bottom line of this trend channel here. It must hold here, I believe it will, and start rallying back up to the 80 level, and I believe it will, because cyclically the short-term cycles for the dollar do point higher going into March. So they're starting to synchronize now. We should see a bounce in the dollar concomitant with a short-term top in gold and silver, and that is what I'm expecting to play out in going into the mid part of this month, the latter part of March, even into early April. The caveat being, if the dollar closes solidly below this support line here, then comes back up to test the underside of this, and this line becomes resistant, then we could see the dollar start falling down to 72 and probably even lower to record new lows. We will have to watch this very closely, because if that happens, it is likely to happen with a breakout in gold above 1453, and then I would be lifting hedges, looking for a good risk return place to get short the dollar and to start adding to gold and silver positions. However, I repeat, I do not expect that to happen. I am watching these markets like a hawk right now, and I do want you, as hard as it is to ignore the mass media and mass emotion out there, to follow me as closely as possible. We're not interested in these markets for short-term moves. There's too much volatility, too much risk. We're interested in the long-term trends here and buying when the reward outweighs the risk and we have good places to enter the market. Let's now go on to the Dow Industrials. The Dow Industrials, since my last video update, did try once again at the 12,400 level, but it appears now that that level is acting as very strong resistance, and we are starting to see the S&P 500 and the Dow start to roll over. I have basically two concerns about this market. Number one, excuse me, this rectangular box here, you can see that this 2-bar section here in the Dow did not lead to a spike high and an isolated high. So there is a chance that we could make one more stab higher up to 12.5, 12.6, 12.8. It's becoming more and more a remote possibility for a variety of reasons, and if we do see the Dow fall below this important cyclical trend line right here, which stands just below 12,000, then my forecast for a move down to 9,000 is on target. So I do not want any investors heavily long stocks right now, except for key natural resource stocks, which in the case of gold should be hedged up until we get further confirmation from this market. If the Dow can get down to 9,000 over the next couple of months, it will be literally the buy of the decade, because as I've been warning you all along, as the dollar begins to lose its reserve status and goes into crash mode, which is not here just yet, but when it does, the Dow and the S&P 500 will inflate substantially higher to new all-time record highs. They will begin to commoditize and monetize, and the best of the crop in the Dow Industrials and in the S&P 500 stocks will start to look like gold, if you will, and they will become inflation hedges and geopolitical hedges going forward. But that's not here yet, okay? It's not here yet, and it won't happen until we see a successful test of cyclical support in the Dow and in the S&P 500, just like I'm calling for in gold and silver.